Yay, we're on.
Hi Ed, how's it
Uh,
going?
awesome, man. Awesome for in context, right? Still sheltering in place, so I'm getting used to the new norm of being indoors. I actually don't mind it that much. I feel like I'm a lot more productive because I had no idea. Well, I had an idea, but I really wasn't thinking much about how much time, effort, and money it takes to go to physical appointments. Like it's
Mm-hmm.
a lot, right? It's the get in the car, it's the drive around looking for parking because out here, guys, parking is not easy. And then pay for parking, then go into, let's say, a cafe, look for a seat to sit in, then go get in line and order your coffee. I mean, if you think about all the steps it takes, I mean,
It's a
it's
lot
a
of
lot.
wasted
You do
time,
5 to 7 of them a day. That's a lot of time. Now I don't have to do any of that, and so I'm super productive, able to multitask on
nice.
my computer and on the internet as opposed to being in the car and then having to answer a text or an email in the car. It's just the logistics of it has gotten for me more exciting.
Well, you have a lot of, you have a lot of customers that you're working with. So, I could only imagine how much useful time that you have that's to address what their needs are. I'm sure you get a ton of phone calls and emails and texts a day.
I do, and a lot of my postings too really elicit a lot of questions, and this is where, and you know me, it's like I have the heart of an educator. So for me, being able to answer questions, it's not necessarily about doing a mortgage. Yes, if you need that and we do the math and it makes sense and I can bless you by either saving you money on a refinance or helping you buy a house, then obviously that's great, right? But I'm not one of these people that just peddles mortgages and I'm always talking about mortgages. I always tell people that look, mortgages is what I do, but it's not who I am. Who I am is a lot more robust. I love on people. You've known me for years. You know that I have a heart for people, especially these times. I don't like to see people suffer. I like to see people win, right? And information is important and education is important. Like, what good does my 35 years of being in finance and in the money business do if I can't deploy it and activate it?
You said 35 years?
Total, if you look at my whole history of being an ex-financial advisor, being in commercial banking and then loans, if you look at the whole time, yeah, 35 years, a long time. I'm getting old, Fatima.
Well, considering, we met, I don't know, I guess it must have been, I don't know, like, geez, at least 13, almost, maybe going towards 15 years. I don't,
It could
maybe,
it could very well be because my
maybe
son's
13 years.
already 6 and we met way before he was an idea.
Exactly.
Yep.
Well, that much knowledge. With that much experience. I've been in the business about over 20 years, and what I've
Yeah.
seen, so being in markets or seeing business throughout these years, we do learn a lot, right? Learning
Oh, tons.
the good times, the bad times, what changes, what to look out for, and just
Yeah.
basically how to foresee things. And right now, as I know that there's a lot of stuff going on. I know COVID-19 has really affected the
Uh,
market.
affected
Uh,
everything, but yeah, the markets
it
particularly.
a lot. So last time we talked about, so one of our previous videos, we talked about how COVID-19 changed, how it helped the rates.
Yeah.
Since then, how has it helped the rates?
Rates have been lately, and what I mean by lately, please understand, folks, that things have been changing every single day. It seems to have leveled out a bit, so rates are still good. Matter of fact, I was pricing a loan. To give you an idea, right? This was on a refinance. This is where a person does not take cash out because when you pull cash out of your house and do a refinance like that, your rate is slightly higher because it in essence becomes a greater risk. When you don't pull out money, it's less risky to the lender because you're not pulling in extra money and you're not getting more indebted. So on a rate and term, meaning you're just looking to lower your rate, I priced out a loan this morning. The house was worth $1,200,000. The loan amount was $675,000, and we were just refinancing that. And the rate was ready, three and a quarter, 30-year
Nice,
fixed,
nice.
2.75% on a 15 years. So clearly, now let me put this in context. By the way, in 1981, the 30-year mortgage peaked at over 21%. Can you imagine? And now we're talking 3.25%. So, I mean,
Yeah,
it's that good. It's still very, very good. So please don't listen to all the myths that are out there that all of a sudden rates are skyrocketing. That's not the case. Have they been going up and down like the chart behind me? Yes, it's literally, that's why I put the chart, by the way, in my background, is because it's been that crazy. If you look at the technical charts, it's been like the one you see behind me. It
Gotcha.
looks like a Richter scale, like an earthquake's happening because it's going up and down every day throughout the day. And it's typically from 6 in the morning, Pacific Standard Time, to 4 p.m. That's when the markets are open.
Got it. So for a minute there, at the just about a couple weeks ago, or maybe 3 weeks ago, there was you said that the rates were still low, but lenders were artificially inflating the rates. How is that going right now?
Yeah, we're seeing that level off as well. So here's why, by the way. It's important that everybody understands why this is happening. In the mortgage business, we have this term called EPO, early payoff. And what this means is that anytime somebody who just got refinances again within 6 months, that causes what's called an early payoff, and the lender has to pay back all the income that they made from that refinance. As you can imagine, can you imagine going back 6 months in your income and they took away the last 6 months of all your income? What would happen to you? It's devastating, right? So, in order to stave that off, lenders are artificially inflating their rates to keep people from refinancing. Is that all lenders? Absolutely not. But has it been a chunk? Yes, because they're trying to stay in business. Look, everything's difficult right now. So they're trying to not go out of business.
Got you. Okay, so that's good to know. So the rates have leveled off. Rates are still really good.
They're awesome.
Okay, so when it comes to loan programs, I know that there's been a lot of changes with loan programs. Can you
Yeah.
tell us like what's changed?
Yeah,
Um,
yeah, yeah. That's an excellent question, by the way. So after 2008, folks, the Dodd-Frank Act, which was really the biggest piece of legislation to come in and regulate and clean up the mortgage industry, created essentially two types of loans. One is what's called a QM, which is a qualified mortgage. Consider that your vanilla type of loan. What are they? You work for someone, your employment is not complicated, you're not self-employed, you work for a company, you get your W-2s, you get your pay stubs, you have some savings, you have really good credit scores, right? You don't have a lot of debt, and your loan amounts are on the smaller side. In this area of the country, typically that loan amount is going to max out at $765,600. Anything above that is considered a jumbo loan, no longer your vanilla loan or QM. The other part, which you can probably suspect, is the non-QM, the non-qualified mortgage. What are those? Jumbo loans, the higher loan amount. Also in that are specialty programs, like, for example, self-employed folks that don't show a lot of income on their tax returns. We can do what's called a bank statement loan. We take the last 12 months of your bank statements and they do an average of your cash flow, meaning money coming in and money going out of your accounts. There's also specialty programs for people who had recent derogatory credit, whether it was a bankruptcy or it was some lates, et cetera, et cetera. It's all these specialty programs. Those have gone away for the most part. So the jumbos have gone away, the non-QM programs have gone away, and now the ones that we're starting to see are what are called the govies. The govies are the FHA, right, where you only put 3.5% down. The VAs for veterans, which is 0% down, and then the USDA, which are agricultural loans. Now, let me say this, let me pause for a second. This doesn't mean that all lenders are doing that. I still have lenders that will do all of the loans that I just mentioned, including the ones that are going away. But I'm a broker. So I get to go out into the universe every day and find out who's still in business and who still has these products, who has good rates, and who has speed. Because those four things are important. So let me give you an example. Let's say you're buying a house, you get into contract. And a lender might have the program, might have really great rates, but they can't deliver because they're slow as molasses. Here's what's going to happen. Your purchase is going to be in jeopardy because if you cannot perform, the sellers can do what is called a notice to perform, an NTP. And that means you got to perform really quickly or they're canceling that transaction. So it's not always just about rate.
Right, absolutely, absolutely. So, so you mentioned banks. There's a lot of banks that are not giving a lot of loans right now. Can you kind of give some feedback about what changed in the lending industry? Like what banks are still in business, what banks
Yeah.
have gone under?
I don't want to go into the specifics of who is still in business because that list is very huge. Like I mentioned, I mean, I have a lot of lenders, but let's talk about real quick why they're doing this. Why are they getting rid of? Because these are considered risky loans. Keep in mind that your QM loans are the ones that are sellable in the open market. Who buys them? Fannie Mae, Freddie Mac. Mostly Fannie Mae. They're the largest purchaser of mortgages. So if the lender, the bank, cannot sell those mortgages, then that means they can't free up that capital to keep lending, which means they can't make any more income. So they
Oh,
have to keep the money circulating, right? And
gotcha.
the only way they can do that is by selling your loan. That's the reason why most of you who own a home or have owned a home in the past have experienced your loan being sold, right? It's because of that. It's to keep the money circulating so that they can make income.
Oh, interesting. Okay. So when it comes to then equity lines, how's that working out these days?
So, an interesting thing has happened. Before COVID 19, I'll just call it C-19 for short, I could do two loans on one transaction. So if we needed to do a first and a second so that we can avoid having to pay the mortgage insurance or PMI, private mortgage insurance, that's called a piggyback loan. You get a regular first, a 30-year fix on the first, and then you would get an equity line as a second loan, right? Because let's say you were putting 10% down, you would get an 80% first, a
Mhm.
10% equity line, and then your 10% that you were putting down, right, for 100% of the transaction, right?
Mhm.
Now there's lenders that are not, those equity line lenders do not want to do piggybacks. They will just do what are called standalone equity lines, which means you're getting an equity line for an existing house because you have a lot of equity and you just want to have an equity line, which by the way, I do recommend everybody that's watching. If you own a home and you have a lot of equity, I highly suggest that you have an equity line of credit because that's just in case money. Okay, equity lines are dirt cheap right now. They're giving them away because a lot of these lenders who do the equity lines are typically what? Credit unions and smaller savings and loans, right?
Mhm.
And one of the biggest measures of health of these organizations, believe it or not, are the number of equity lines that they give out every year. People don't know this. Like your Patelcos, like your Redwood credit unions, they're judged on the number of equity lines that they give out every single year. So guess what? They promote that heavily because they can't really compete on regular mortgages. They're just not those type of banks. They can't compete with me. I'm going to have better rates and I'm definitely going to be faster because credit unions, and I love credit unions, by the way. So if you work for one, my hat's off to you. I really do. I have a credit union account myself, but they're just not as fast.
Got you. Okay. So when someone's purchasing or doing a refinance, what do they expect as far as like conditions? You know, as far as conditions and appraisal.
Yeah, that's another great question. Yeah, a lot has changed in that arena too. So a couple of things. Number one is verification of employment and income. Here's what's happening. We're doing our initial one just like normal, but then what they're doing, the lenders are doing is that they're verifying employment and income because let's be honest, you never know, right? People are losing their jobs or getting reduced pay or reduced hours. So
Mhm.
lenders know this. We watch all the news, right? So they're checking again, right, as they have what's called the clear to close. Clear to close means we're about to fund,
Mhm.
right? So right before funding, they're going to check again. And then some lenders are even checking after they fund the loan to make sure you're still employed and you're still making the amount of money that they approved you for as income, right, to qualify. So that's number one. As far as appraisals go, appraisals are still happening. That it's all dependent on whether that appraiser wants to go out and do the appraisal or not. So we have what are called appraisal management companies. Those are called AMC, appraisal management companies. The appraisal management companies are the ones who hire all the appraisals. So they have a bunch of them. So what they do is that as soon as we order the appraisal, they throw it out to their network of appraisers to see who will accept the appraisal order.
Mhm.
It's harder these days because appraisers are also human beings and they're afraid of catching the C-19, right? So some
Right.
of them won't do it. But there are some that will and who have systems in place to make sure that the homeowners are out of the property, at least for that period of time. And a typical appraisal will take anywhere from 45 minutes to an hour. I'm seeing actually less time. What I'm noticing is that appraisers are just going in, measuring real quick, taking some pictures, and they're out. I'm not seeing them doing all of the work they used to do for an appraisal. That's just what I'm seeing. Okay. But
Right.
then once the appraiser accepts it and they have a system in place, it's, they go out and they do it.
Okay. Yeah, I mean, I think we're all adapting with today's ways of
Totally.
doing business, and we have to keep safe. It's so important. Well, I think that this, we covered a lot of questions. Are there anything before we wrap it up that you want to just say? Any tips? Any
Yeah.
recommendations?
Well, you know me, I'm never short of words. So here's what I'm going to say: do not allow any virus or any person or circumstance to get in the way of what you had already dreamed of doing. Times are tough, it's true. However, look at history. We human beings are extremely resilient. We get through some crazy stuff. And need I remind you, Hitler, world wars, pandemics, SARS, 9/11, I could keep going.
Yep.
There's always stuff. It's part of life. Please don't just put things on hold. Reach out to ninjas like Fatemah and myself who do care. We're not in this business just for the money. Yes, we do all need to eat, but there's three types, or there's a transition in one's work history. You go from having a job, which I call just over broke, right, to having a career. And then ultimately, which is the nirvana of this, is what I call a calling. For Fatemah and I, this is a calling. We feel called to do this because we
Mm-hmm.
have options to work other places.
Mm-hmm.
Even after 2008, everybody was telling us, go get a real job. This is our real job. This is our calling. This is what we do. We love to put people in homes because we've seen the difference that has made in people's lives. That you get a step up in your life when you own a home. It's true. And if you want to talk about details and how I see it and how I can prove it, please reach out to me. Matter of fact, just reach out to us anyway. If
Mm-hmm.
you're feeling a little bit worried and thinking maybe I should hold off, I'm telling you, once this thing is over, you're going to wish you didn't. Just like in 2008, who made out like bandits? The
Yep.
people who bought properties at 40 to 60% off. Those
Mm-hmm.
are the people who made out because imagine what those houses are worth today. Imagine if you froze and didn't do anything and you could have. I'm just saying,
I know.
get
I
the
kick myself
facts
too.
first, right?
I mean, there's plenty of us. Yeah, I mean, I was there. We were there, and it is a scary time for folks.
It is.
That,
I'm not trying to minimize it
yeah, it
or
is a
be
scary time.
preachy. I'm just saying, don't kill the dream.
Right. If you have the means, for sure. I mean, if you have the means and you have the options
And
to
we're
make
going to
moves,
tell you.
yeah, for sure.
That's part of my job is to tell you whether you can or can't and to what extent. I'm here
Absolutely.
to tell you exactly what your ceiling is. What can you afford? I'm having to tell a guy today that, you know what, unfortunately, in your situation, you can't afford anything. Why? Because what you can't afford is 200,000. That ain't going to happen here. You
Yeah.
could, yes, you can afford 200,000 in Tennessee,
Yeah.
but you ain't going to buy in the Bay Area for 200 grand. It's not going to happen. I have to give him that information. However, what I am telling him is that if you want to go up, here are the following homework pieces you need to do. You need to pay off debt. We need to work on that credit because your scores are low, and we need to start saving money, right?
Mm-hmm.
And or get somebody else who wants to do the same thing you're doing, and maybe you guys buy a duplex instead of one house. Is
You're
it
fighting it.
perfect?
Yeah.
No, but is it
Yeah.
better than renting? Yeah,
Absolutely. No, for sure. I mean, and exactly like if you can take these times to benefit you, for sure. I mean, there's still people that really need to that have stable jobs that still need to move or find leverage in this type of environment and this market. But
yeah,
if things are scary, don't. I mean, we're not here to encourage like pushing yourself to uncomfortable levels. It's like more like if it
yeah,
works for you, awesome. We're here to help and
yeah.
help you strategize.
Yeah, if after everything I've said you still feel fearful and you feel like you need to hold off. Look, we respect your decision. All I'm saying
Absolutely.
is get the facts and then go from there.
For sure. For sure. Or partner up with somebody, like you said. So, yeah.
Yeah.
All
Hey,
right.
sometimes you got to two-step it instead of one-step. Everybody wants to hit home runs. Who doesn't? But sometimes you got to get at least on base, right?
There you go.
All right.
Well, I appreciate your knowledge and expertise always.
Yeah,
And thank
thank
you so
you.
much
Thank
for
you.
sharing that with us
All
today.
right. Well, everybody, if you need to get a hold of me, Ed at Kuno Advisors, and that's KUN as in Nancy O Advisors with an S at the end. Or just hit me up on my cell phone, 415-368-1149. Send me a text, call me. Always, always open to have a conversation and let me custom tailor the info to your situation. And how do they get a hold of you?
Absolutely. So I'm Fatemah Nikchehi, and my cell phone number is 415-756-4418. And I would say that's the best way to get a hold of me. You could call or
All right,
text.
cool.
Thank you
You heard it
guys.
here first. Everybody stay strong and stay healthy. Take care.
See you.